Imagine this. You wake up one morning as an ordinary person. Maybe you're an accountant buried in spreadsheets. Maybe you're a college dropout wondering what to do next. Or maybe you're a sound engineer who has never even looked at a stock chart. Now imagine that just 4 years later, you've made millions. And not by winning the lottery, not by inventing the next iPhone, but by trading the markets in a way so simple it almost sounds like a scam. Sounds impossible? In 1983, one man proved it wasn't. His name was Richard Dennis, and what he did would shake Wall Street to its core. This isn't fiction. This was the turtle trading experiment, and the results shocked the financial world. Dennis believed that great traders weren't born. They could be made from scratch. All they needed was the right rules, the right mindset, and the discipline to follow the system without hesitation. By the end of this video, you will know exactly how the turtle system worked. You'll see why it still works today, and you'll discover how you can use it to outsmart most day traders and swing traders in 2025. But let's rewind. It all started with a $1 million bet between two friends. Richard Dennis, a Chicago commodities trader who had turned a few $100s into over $200 million, believed anyone could learn to trade successfully. His partner, William Eckhart, disagreed. Eckhart thought trading skill was something you were born with, like perfect pitch or artistic talent. The two decided to settle it the old-fashioned way, by putting real money on the line. Richard Dennis placed an ad in the Wall Street Journal. It cost just $400, but that ad would end up creating a team of millionaires. The ad called for people from all walks of life. No trading experience needed, just the willingness to learn. And the people who answered? They were nothing like the Wall Street elite. There was a blackjack player, an Air Force pilot, a 19-year-old programmer, even a man who had been working in the sound department of a film studio. They were about to become known as the Turtles. The name came from an inside joke. Dennis had recently visited a turtle farm in Singapore. He told his recruits, "We're going to grow traders just like they grow turtles, fast and in batches." Over 2 weeks, he taught them a simple mechanical trading system, a system so straightforward that you could write it down on a single sheet of paper. There were no complicated algorithms, no Wall Street jargon, just rules, exact rules. When to buy, when to sell, how much to risk. And here's where the story takes a strange turn. The system actually lost money most of the time. Over 60% of their trades ended in a loss, and yet they made millions. How can you lose more trades than you win and still come out ahead? The answer is the same secret that most traders never learn. It wasn't about being right. It was about letting winners grow and cutting losers fast. He taught them the art of position sizing, betting bigger when the odds were in your favor, and keeping losses small when they weren't. He called it the backbone of the system. And over the next 4 years, this little group of misfits turned that one sheet of paper into more than $100 million in profits. They didn't just beat day traders. They didn't just beat swing traders. They outperformed Wall Street veterans who had been in the game for decades. Now here's why this matters to you. That system, it still works today. In stocks, in commodities, in Forex, even in cryptocurrency. The principles are timeless. They don't rely on predicting the market. They rely on reacting to it. So if you've ever thought trading was about reading the news faster or predicting the next big move, think again. The turtle strategy shows you how to turn uncertainty into profit and why following the system can beat even the smartest traders in the room. Stay with me, because in this video, I'm going to break down the exact rules they used, the psychology that kept them going when they were losing 60% of the time, and the step-by-step blueprint that can turn you into a systematic trader in just 90 days. The question is, will you follow it?
You see, Richard Dennis wasn't your typical Wall Street guy. He didn't grow up in a mansion. He didn't wear fancy suits or hang out in country clubs. He was a kid from Chicago who started with just a few $100s and turned it into over $200 million by trading commodities. But here's the thing. Dennis didn't think he was special. He believed trading success wasn't some magical gift. It was a skill anyone could learn if they were willing to follow a set of rules without letting emotions get in the way. His friend William Eckhart disagreed. He believed great traders were born with a special instinct, an almost sixth sense. You either had it or you didn't. So they made a bet, a big one. Dennis would recruit a group of complete beginners, people with zero trading background, and in just 2 weeks, he would teach them his exact system. Then he would give them real money to trade. If they succeeded, it would prove his point. That's when the ad went out. A simple $400 notice in the Wall Street Journal. It said they were looking for people to learn a unique trading method. No experience needed. The results would shock everyone. Hundreds applied, from all walks of life. A blackjack player, an Air Force pilot, a security guard, even a 19-year-old computer programmer. Dennis chose a handful of them. Ordinary people. People who had never traded a single futures contract in their lives. These were his turtles. The name came from a trip Dennis had taken to a turtle farm in Singapore. He joked that he could grow traders just like they grow turtles, quickly and in batches. And that's exactly what he set out to do. Over the next 4 years, these students would take Dennis's simple rules and turn them into over $100 million in profits. And here's the part Wall Street still doesn't like to talk about. They were losing money on more than 60% of their trades. How is that possible? That's what you're about to learn. Because in the next few minutes, I'm going to take you inside the exact system Dennis used. I'll show you how it works, why it still works, and how you can adapt it to beat most traders in 2025, whether you trade stocks, commodities, or even crypto. So get ready. This is the full story of the turtle trading experiment and your blueprint for becoming a systematic trader.
Section 1. The Origin. The year was 1983. The financial world was buzzing with big money, bigger egos, and a belief that successful traders were some rare breed of genius. But Richard Dennis had a different idea. He believed trading could be taught like any other skill. He'd say, you don't need to predict the future. You just need to react to what's happening and manage your risk better than the next guy. To prove it, he designed a bold experiment. First, he placed that now famous ad in the Wall Street Journal. The headline didn't scream in giant letters. It wasn't flashy. It simply invited ordinary people to learn a trading method that could change their lives. The response was overwhelming. Hundreds applied. People wrote long letters about why they wanted a shot. Some bragged about their gambling skills. Others simply said they were tired of working dead-end jobs. From this pile of applications, Dennis and Eckhart chose a small group. And these were not the people you'd expect to find on a Wall Street trading floor. There was a blackjack player who had mastered card counting, an Air Force pilot used to making life-or-death decisions in seconds, a 19-year-old computer programmer who was more comfortable with code than with people, even a security guard who had never even owned a stock before. They were about to become millionaires. Dennis called them the Turtles. The name wasn't random. On a trip to Singapore, he had visited a turtle farm. The farmer explained that they could raise turtles quickly in large numbers with the right process. Dennis smiled and thought, "That's exactly what I'm going to do with traders." For 2 weeks, Dennis and Eckert trained them in a classroom in Chicago. The rules they learned could be written on a single sheet of paper. Buy when prices break out above a certain point. Sell when they fall below another point. Cut your losses fast. Let your winners grow. Always risk only a small percentage of your account on any single trade. No guessing, no predicting, no gut feeling. And here's the twist. The system wasn't designed to be right most of the time. In fact, more than 60% of trades would lose money. But the losers would be small, and the winners, they would be massive. This was completely opposite to what most traders did. Most people hold on to losing trades, hoping they'll turn around, and sell their winners too soon, scared the profit will disappear. The turtles learned to flip that thinking upside down. And the results? In just 4 years, this group of total beginners made more than $100 million in combined profits. They didn't just prove Dennis right, they destroyed the myth that great traders are born, not made. Now, you might be thinking, if the rules were so simple, why doesn't everyone do it? Why isn't every trader a millionaire? The answer is simple, but hard to live by. It's psychology. Because when you're losing trade after trade, even when you know the math is on your side, your brain screams at you to stop, to change the system, to quit before you lose more. That's why Dennis's training wasn't just about the rules. It was about the mindset, about building the discipline to keep trading the system, even when it feels like the market is out to destroy you. And that's where we head next, because the psychology of losing is what separates the millionaires from the masses. And it's the same skill you'll need if you want to survive in 2025's wild markets.
Section 2. The system that broke the rules.
When most people hear the word trading, they imagine complex charts, screaming brokers, and 100 blinking indicators. The turtle system was nothing like that. It was mechanical, clear, and ruthlessly simple. Richard Dennis gave his turtles exact rules for entering and exiting trades. There was no guesswork, no room for personal opinion. It was like following a recipe, but the recipe was for making money. Here's the core of it. They traded trends, not predictions. They didn't care if the market was overbought or oversold. They didn't care what the news said. If prices broke above a certain high, they bought. If prices fell below a certain low, they sold. Simple. But here's the catch. Most of those trades lost money. The turtles knew that more than 60% of the time they would be wrong. So why did it work? Because the wins were huge. This is where Dennis taught them the real secret, position sizing, the idea that how much you bet is even more important than when you bet. Most traders risk the same amount on every trade. The turtles didn't. They risked a fixed percentage of their account, usually just 1 or 2% on each trade. That way losses stayed small, but when a trend took off, they added to the position, stacking profits like bricks in a wall. Dennis called it the pyramid principle. Instead of betting big at the start, you let the market prove you right. Then you press the advantage. You add only when you're winning. It sounds obvious now, but it's the opposite of what most traders do. The average trader doubles down on losers, hoping to get even, and sells winners too soon. The turtles did the reverse, and that small change was worth millions. For example, imagine they bought gold at $400 an ounce. The moment it rose enough to confirm the trend, they added another position, then another. If gold kept climbing, their profits grew exponentially. If it reversed, the loss was small because they entered cautiously. The beauty of the system was that it didn't matter what market they traded. Stocks,
commodities, currencies. Even in today's world, it works in crypto. The rules didn't change because the principles were timeless. And this is where you need to pay attention, because these same rules can give you an edge in 2025. Forget trying to predict the next Federal Reserve announcement. Forget hot stock tips from Twitter. If you learn to trade the way the turtles did, you'll stop playing the game everyone else is playing and start playing a game you can actually win. But there's a reason this strategy, as powerful as it is not used by most traders today. It's not because it stopped working, it's because of psychology. Following a system that loses the majority of the time is emotionally brutal. Imagine losing 7 trades in a row. Your brain starts whispering, "This isn't working. Change it. Try something else." That's when most people abandon the plan, and that's when they lose. The turtles didn't give in. They trusted the system. Even after a losing streak, they kept placing trades exactly as the rules said, because they knew one thing most traders never truly understand. Your job is not to win every trade. Your job is to follow the plan. The profits are just the reward for doing it right. And this mindset would be tested to its absolute limits when real money hit the table and the first big wins and losses rolled in. That's where we go next.
Section 3. The Psychology of Losing. If there's one thing that destroys more traders than bad strategies, it's their own minds. The turtle system looked simple on paper, but in real life, it was a mental war. Here's why. Most people think winning trades feel good, and they do. But in the turtle system, you had to survive long stretches of losses, sometimes weeks, before those big wins came. Over 60% of trades ended in the red. That meant more than half the time you were wrong, over and over again. Imagine this. You enter a trade, you follow the rules. It hits your stop loss, and you lose money. Then it happens again, and again, 7 times in a row. You start questioning everything. Maybe the rules are broken. Maybe the market has changed. Maybe you should just sit this one out until things feel safer. That's exactly how most traders destroy themselves. But Richard Dennis had prepared the turtles for this. He told them from day one, your job is not to be right. Your job is to follow the rules. That's easy to say when you're in a classroom. It's a different story when you're watching your account balance shrink. One turtle later admitted there were days he wanted to quit. The losses felt like constant punches to the gut. But then, just when it seemed hopeless, one huge trend would hit, and that one win would wipe out weeks of small losses and push the account to new highs. This is where the magic of the system came alive. Think of it like a casino. The casino doesn't win every hand of blackjack. In fact, it loses plenty of them. But over time, the odds are stacked in its favor, and because it sticks to the math, it wins big in the long run. The turtles became like the casino, emotionless, patient, willing to take small losses over and over, knowing the math would eventually deliver a jackpot. And here's something else most people don't realize. Those losing trades, they weren't failures. They were the cost of doing business. Without taking those small losses, you'd never be in position to catch the big winners. But that kind of discipline is rare. In one famous example, during the 1987 market crash, Black Monday, the turtles didn't panic. While most traders were dumping positions out of fear, the turtles simply followed their rules. Some even made money during one of the worst days in stock market history. That's the power of having a system you trust more than your own emotions. And here's the takeaway for you. If you want to survive and thrive in trading, you must accept losing is part of the game, not as something to fear, but as something to master. Because in 2025, the markets will still punish emotional traders, but they will reward the disciplined ones who can stick to their plan. And speaking of discipline, in the next section, we're going to see how the turtles use their strategy not just to survive, but to grow massive profits using one of the most counterintuitive money management techniques ever taught.
Section 4. The Legacy and Evolution. By the late 1980s, the turtle experiment had become legend. A group of total beginners, hand-picked from newspaper ads, had taken a simple set of rules and turned them into more than $100 million. Wall Street couldn't believe it. Many dismissed it as luck. Others said the markets had simply been in the right kind of trend for that system to work. But here's the truth. The turtles were proof that a mechanical, disciplined approach could outperform even the smartest market analysts, and that truth made a lot of professionals uncomfortable. After the experiment ended, the turtles went their separate ways. Some started hedge funds, others became independent traders, a few quietly disappeared from the spotlight. But the DNA of that strategy, the trend following, the position sizing, the discipline, spread far beyond that original classroom in Chicago. And here's the twist most people miss. Trend following didn't stay popular forever. By the late 1990s and early 2000s, markets became choppier. High-frequency trading was on the rise. Many declared the death of trend following. Articles popped up saying the turtle method was outdated, that the markets had changed too much. But then it came roaring back. In times of crisis, when chaos hits the markets, trend-following strategies have a way of shining. The 2008 financial meltdown, the 2020 COVID crash, even sudden geopolitical shocks. In these moments, traders with mechanical systems often find themselves ahead, while emotional traders panic and make costly mistakes. The lesson is simple. Market conditions may change, but human behavior doesn't. Fear and greed still drive prices, trends still form, and those who have the discipline to follow them still have an edge. In fact, some of the original turtles went on to teach a second generation of traders. They adapted the system for new markets, from foreign exchange to tech stocks to cryptocurrency. The rules were tweaked for speed, volatility, and modern data feeds, but the core philosophy stayed the same. Follow the rules, manage risk, let winners run, cut losers fast. And here's the exciting part for you. The tools available today are better than anything the original turtles had. Real-time data, charting software, automated position sizing calculators, backtesting platforms. The strategy that once needed a classroom and a stack of paper now fits into a smartphone app. But the question isn't whether you can trade like a turtle in 2025. The question is whether you'll have the discipline to do it when it matters most. Because as we'll see in the next section, modern traders are using turtle principles not just to keep up with the market, but to outpace the fastest day and swing traders in the world. And they're doing it in markets Richard Dennis could never have imagined, including crypto.
Section 5. The Modern Turtle Playbook. The beauty of the turtle system is that it wasn't built for just one market. It was built for human behavior, and human behavior doesn't expire. That's why the same rules Richard Dennis taught in 1983 can still work in 2025 with a few smart updates. First, the markets have changed. Back then, the turtles traded mostly commodities like gold, soybeans, and oil. Today, we have a universe of options: stocks, ETFs, Forex, index futures, and of course, cryptocurrency. Here's the good news. The principles are the same. Trends happen everywhere. Whether it's Apple stock breaking to new highs, Bitcoin exploding after a long consolidation, or crude oil collapsing after geopolitical news, the turtle playbook can capture it. So, how does the modern turtle operate? Let's break it down. Step 1. Scan for breakouts. Instead of watching a handful of markets, today's trader can scan hundreds at once using screeners.
We look for price breaking above recent highs or dropping below recent lows. That's the trigger zone, just like in the original rules. Step 2. Calculate your position size automatically. The original turtles used paper, calculators, and formulas to determine how much to trade. In 2025, you can use apps or spreadsheets that instantly adjust for your account size and risk level, 1 or 2% per trade. No exceptions. Step 3. Stack winners, not losers. This is still the hardest part for most traders. If a trade moves in your favor, you add to it in small, controlled increments. If it moves against you, you cut it, no hesitation. It's the pyramid principle in action, and it's still one of the most profitable money management tools ever created. Step 4. Go market agnostic. The turtles didn't care what they were trading, only how they were trading it. That's even more powerful today. You might be long tech stocks one month, short commodities the next, and in crypto futures after that. The asset changes, but the process doesn't. Now, let's talk about crypto. If Richard Dennis had access to Bitcoin in the 1980s, he probably would have loved it. It's volatile, it trends hard, and it creates exactly the kind of outsized winners that the turtle system thrives on. In fact, some modern traders are running what they call the crypto turtle experiment. Same rules, same risk management, but instead of commodities or stocks, they focus entirely on the crypto market. The results? When trends hit, the returns can be staggering. But, and this is the part most people skip, the losing trades are still there. You still have to endure strings of losses. You still have to stay mechanical when the market is whipsawing. The rules are only as good as your discipline. And that's the real challenge in 2025. With information overload, constant social media noise, and a flood of hot tips every day, the temptation to abandon your plan is higher than ever. The traders who will win are the ones who can block out the noise and execute their system like a machine. Because at the end of the day, the market doesn't care about your feelings, your hunches, or your predictions. It rewards consistency. And the turtle system is consistency distilled into a set of rules you either follow or you don't. In the next section, we're going to get personal. You'll see exactly what happens in a trader's first 100 turtle-style trades and why those first 100 can completely transform the way you see the markets forever.
Section 6. Your 90-day transformation. You've heard the story. You've learned the rules. But here's the truth. None of it matters unless you take action. Richard Dennis didn't just hand the turtles a set of instructions and wish them luck. He put them in the markets, day after day, trade after trade. They learned by doing, and that's exactly how you'll learn too. The first 90 days of trading like a turtle aren't about getting rich. They're about rewiring your brain to think like a systematic trader. That means you stop chasing hot tips, stop making emotional trades, and start trusting a repeatable process. Here's your roadmap. Days 1 to 10, build your foundation. Choose the markets you'll trade. Set up your charting and screening tools. Learn the breakout rules. Practice position sizing until it becomes second nature. The goal here is preparation, so when it's time to trade, you know exactly what to do without hesitation. Days 11 to 30. Start with paper trading or small real positions. The point here isn't to make money, it's to train your discipline. Follow the breakout rules exactly. Cut losses without argument. Add to winners without fear. This is where you start feeling the emotional pull to just make an exception, and you learn to ignore it. Days 31 to 60. Increase your exposure slightly. If your process is solid, you'll start to see small gains. More importantly, you'll experience losing streaks and learn they don't define you. Keep your risk percentage locked. Never bet bigger just because you feel confident. Days 61 to 90. Full commitment. By now you're operating like a machine. You take trades without hesitation. You're no longer afraid of losing trades because you've seen the math work. This is when you start thinking long-term, tracking your performance over hundreds of trades, not just a few. And here's the key. The first 90 days aren't about profits. They're about building the muscle of discipline. Because once that muscle is strong, the profits take care of themselves. The turtles didn't win because they had insider information. They didn't win because they were smarter than everyone else. They won because they followed the plan, through good days, bad days, and market chaos. Now, you face the same choice they did. You can keep trading on impulse, hoping to get lucky. Or you can commit to a proven process and give yourself a real edge in the markets of 2025. So here's my challenge to you. Don't just watch this video and nod along. Take the first step. Pick your markets, write down your rules, and commit to 90 days of pure discipline. Because the market rewards action, not intention. The turtles succeeded because they didn't just learn the system, they became the system. And if you're ready to do the same, type it in the comments right now. Day 1 begins now. I am the system. Your journey starts today.